Welcome to another episode of Real Estate Investing Explained. Here's today's question. And when we talk about using retirement funds, we're not talking about logging into your Vanguard account or Fidelity account and using that same type of account, correct? We're talking about having to set up a different account, which is called the SDIRA, which is a self-directed IRA. Talk to us a little bit about the difference between that type of an account that you can use for real estate and what you can't use for real estate.
So you have to open up a separate IRA. It's an IRA custodian, and you can just Google IRA custodian. And the only difference is that you write a form to your Vanguard and they transfer whatever money to this IRA custodian. Once it's in the account, you fill out a form that says, hey, I want you to wire X amount of dollars to this particular LLC that I want to invest in. And that's exactly what they do. And now your IRA has shares in an apartment building or an LLC or a nightclub, whatever you want to own, right? I don't care. And so you can, it's called self-directed. So you can direct yourself where that money goes. And the law allows a very broad spectrum. Now, there are some laws governing it. For example, you can't invest your own deal. It's got to be an arm's length transaction where you can't directly benefit. And of course, you can't have any of the money coming back in your grubby little hands. It's got to go back into the IRA. But there's a problem with the IRA investing. And that is you are subject to a tax, believe it or not, which hit me like 15 years ago when I invested with my IRA in an apartment building a long time ago before I even got started in this myself. All of a sudden, I was notified that I have to pay a tax. It's the UBIT tax, the unrelated business income tax. In my IRA, I'm like, what are you talking about? This is tax-free. No, the UBIT is triggered for investments that use leverage or a mortgage like a real estate normally does. So when this guy sold his apartment building, it triggered his tax. So I had to file taxes out of my IRA. I had to get an EI tax ID number. I had to file retroactively to 2007, pay penalties and interest and filing fees for not having filed the tax. And it was a god-awful mess. And I'm like, this can't be. This cannot be. So what's the solution to that, you might ask? And it's to set up a solo 401k. And my good friend Damien Lupo talks about this. It's called the EQRP. EQRP is essentially a solo 401k that bypasses the UBIT entirely. But the best thing, well, that's pretty darn good because it saves you basically taxes. It's a little more expensive to send up, but not much more. And you can also sign the documents yourself, which is a major benefit because when you're investing in a syndication, it moves very quickly. Sometimes these things are sold out so quickly, but the paperwork process with your custodian can take days, sometimes even a week. And by that point, they're already subscribed because the process requires a custodian to sign the documents on your behalf. So you're not signing it directly. The whole thing is horse manure myself, but that's the process. With this solo 401k, you can sign, you are your own custodian. I'm my own administrator, so therefore I can sign subscription agreements, everything else myself and get it done within an hour or two. So I really love that. So we're directing all of our past investors to the EQRP route for those reasons.
So I love this idea as well. I've studied it quite a bit, so I know a decent amount about it. I definitely don't know everything, but I know enough to be dangerous. And obviously, you know quite a bit about it as well. So I think it could be intimidating for a lot of people, though, that hear this. We hear this conversation. You and I kind of get it. We can have this conversation, but people listening might not, who don't have the background that we do, they just might be thinking, this just sounds too complex. How do you explain this to people when they haven't done anything like this before? So if you're going to someone and you want to raise money from them, how do you explain this to them in simple terms so that they understand what they're actually doing and you can actually get access to their funds?
Look, I mean, there's going to be some people who are more ready than others. Some people are going to be resistant to the idea because change is a scary thought. Every person moves on a different timeline. The point is that you're constantly educating your investors, wherever the stage they are. Eventually, one day, they'll hop on board, some sooner rather than later. I think the biggest thing from an investor mindset is to have an open mind and to start really paying attention more to your financial future. Most people don't. They sock their stuff away automatically. It's a direct, withdrawal from their account into their Vanguard account. A mutual fund allocated XYZ. They don't even know how much money they're putting in. They don't even know how it's doing. Or they have a financial advisor if they have a little bit more money and he or she's doing some stuff. They don't really know what the heck's going on. And this is a problem. And none of these people are qualified, frankly, and the vehicle itself is not reliable. So the biggest thing is that when an investor or person wakes up to that, especially recently, like, I got to start paying attention to stuff. Like, maybe there's something I could have done had I known it or been reacted to it, or maybe my allocation could have been different. Maybe it's going to rattle us a little bit, and they're going to be more open to the idea of not only alternatives, but to start paying attention a little bit more. That's the thing. If people just kind of drift through stuff, they're not going to be your candidate, right? You need someone who's curious, who's looking for alternatives, and who's prepared to put a little bit of time into it. Because you're right, you got to put a little time in to read a blog post or watch a video or read something, and you got to put a little time to do some paperwork to actually move funds around. So there is actually some action required, and if someone doesn't want to do that, it's not going to be a good fit for them.
And so would this be considered in all cases a syndication where you have to have legal filings with the SEC in order to do this type of thing? Or can you do it on smaller deals without having to go through all of that with the SEC?
You also have to pay attention to the law, whatever you call it. And the SEC securities are really there to protect you. So the question I always get, well, if you're doing a quota syndication and you're doing it with friends and family, do you need a private place? Do you need some of the SEC documents that cost $12,000, $15,000? And I say, well, it depends. The regulations are there to protect you. So if you don't file the proper filings and forms that cost money, and the deal goes south, and your investors start to want to sue you or figure out how they can get you, they're going to call the state SEC and they're going to look and see if you have the filings. Oh, you don't have filings? And they may launch an investigation on you. Okay, do you want that? Are your investors inclined to do that? If your investors are friends and family, are they really going to sue you? They may not speak to you at Thanksgiving anymore. Are they going to sue you? Are they going to call the SEC? I don't know. It's up to you, right? Probably not. Okay, so do you want to do it for a small deal? It's up to you. It is how you assess the risk of that. If you want to mitigate your risk, then it is probably best to do that. Now, you can also structure the entities differently as well. You can do a joint venture, for example, whereas let's say it's you and 5 other investors. If you structure the LLC that they're all essentially equal partners, everybody's got an equal vote, even though you're doing all the work, that does not require SEC registration because everyone's equal. It's just a majority vote. But typically, the reason that the SEC protects the investor, they are limited. Let's call them limited partners. They have limited liability, but they also have limited involvement. And because they have limited involvement, they don't have major say over things. That is why they're being protected by these disclosures and things of that nature.
Yeah, that latter situation that you just mentioned was exactly what I was thinking about. I think there's probably people listening to this that are going to say, okay, this might be a good source of funds for me to do a deal. Maybe I could go out and get an 8, 10, 12 unit property. Do I really need to do a whole syndication for that? Or could I just do a joint venture and do an LLC? Can people still invest in the deal that way using their IRA? And then would I still need the paperwork from the SEC?
Yeah, again, like I described, if you do an equal partnership, the answer is no. You got to be careful with the IRA though, but with IRA money. But yeah, you don't need that. But again, you should have obviously I'm not an attorney, and you should have your attorney advise you on these things. I'm just giving you a couple different ways to do it where you can save some money on the attorney costs, and that's certainly one way to do it.
And in that case of the joint venture LLC, again, I'm not an attorney either, but you have your operating agreement, which outlines a lot of what would be covered, I'm guessing, in the SEC documents. But so can you do that type of joint venture deal with these IRA funds that we talked about?
You certainly can if in a limited. So if people are passive limited investors, they can certainly invest with their IRAs. If you're an active person, unless you're a general partner, there are limitations. You can't use your IRA to invest in things that you control. Okay, it's not an arm's length transaction, so you can't do that. You have to pay attention. If you're the active investor, the best thing to do is if you have an IRA, which you probably shouldn't. I still have mine from long time ago. But if you do, you can invest with other operators and other people's deals as a limited partner.
So what is the definition of being active in that case? Say myself, I wanted to buy a 10 unit and I wanted to get people to invest in that with their IRA, and we were going to do it through an LLC. Is that technically considered an active investor for them?
If you structure it like an equal partnership, then yes, they're all considered active partners. They all have equal decision making. And so I would be very careful in having them invest in that deal. It would be better if you structure it more like a general partner, limited partner. And then, of course, SEC regs apply. And then you have to decide whether you want to go through the process or not.
And you mentioned leverage. So people are able to still get bank loans when they get funds from people's IRAs?
Yeah, absolutely.
That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.